At the end of April 2026, global ETF assets reached $21.91 trillion. That is not a niche product anymore. It is a hidden market machine. Every month, money flows into this machine, gets turned into shares, and trades all day like a stock. In April alone, ETFs gathered $218.97 billion of net inflows, and year-to-date inflows reached $856.38 billion. The machine is still expanding. Most investors only see the ticker, but underneath that ticker, two prices are trying to meet. One price is what traders pay on the exchange. The other is the value of the assets inside the fund. The mystery is simple. Why do those two numbers usually stay close? The answer is not trust. It is arbitrage. The naive model says an ETF is just a box full of stocks, bonds, or other assets. Divide the value of the box by the number of shares, and you get NAV. But ordinary investors do not usually buy that box from the fund. They buy ETF shares from other investors on an exchange. That creates two markets at once. The secondary market, where almost everyone trades the ETF share, and the primary market, where APs exchange large blocks with the fund. BlackRock's iShares disclosure says ETF shares are bought and sold at market price, not NAV, and are not individually redeemed from the fund. So the ETF share has a market price, and the fund has a net asset value, related but not identical. When the share trades above NAV, the gap is a premium. When it trades below NAV, the gap is a discount. Start with the accounting identity. NAV per share equals assets minus liabilities divided by shares outstanding. Now use a toy ETF with 3 securities worth $10 million, no liabilities, and 1 million shares. The NAV is $10. That is the value of the box per share. Now, put that next to a market price of $10.20. The ETF is not broken. It is expensive relative to its basket. The premium is price minus NAV divided by NAV. In this example, 20 cents divided by $10 is 2%. If the sign were negative, the same formula would call it a discount. The formula does not judge the gap, it only measures it. That 2% is the signal. It tells arbitrageurs there may be money on the table. The key player is not the retail investor. It is the authorized participant. Think of the AP as a large broker-dealer with permission to trade directly with the ETF in creation units. Investor.gov gives 50,000 ETF shares as an example of the block size, which is why this pipe is not built for one-share retail orders. This matters because the AP can access both sides of the machine, the securities inside the fund and the ETF shares trading outside it. If the ETF trades above NAV, the AP can buy the underlying basket near $10. Then the AP delivers that basket to the ETF sponsor and receives newly created ETF shares. Finally, the AP sells those ETF shares in the market near $10.20. Creating and selling shares adds supply where the price is too high. Buying the basket adds demand where the basket is cheap. Those two forces squeeze the premium back towards zero. The redemption loop works in reverse. If the ETF trades below NAV, the AP can buy the cheap ETF shares in the market. Then the AP delivers a creation unit back to the fund. In exchange, the AP receives the underlying basket or a cash equivalent through the redemption process. Buying the ETF adds demand where the price is too low. Selling or hedging the basket adds pressure where the basket is rich. Again, the gap narrows. Not because anyone promises it must, but because the trade becomes attractive when the gap is large enough. APs are not required to rescue every price. They act when the expected spread is larger than the cost and risk of the trade. But this is the part many simple explanations skip. Arbitrage is not free. The true condition is not price equals NAV. The true condition is that the gap must exceed trading costs, hedging costs, financing costs, basket uncertainty, and liquidity risk. So the ETF does not live on one fair value line. It lives inside an arbitrage band. Inside the band, the gap may exist, but it can be too small or too uncertain to harvest after costs. When markets are calm and the underlying assets are liquid, the band is thin. When the basket is hard to trade, the NAV is stale, or funding is expensive, the band widens. That means a premium or discount is not automatically a failure. Sometimes it is a real arbitrage gap. Sometimes it is an optical gap from timing or stale marks. The question is not simply, why is price different from NAV? The better question is, what does it cost to close the gap? That is the hidden variable most ETF explainers leave off the screen. This is why bond ETFs are the real test of the machine. An equity ETF can often use a basket that looks almost identical to its holdings. A bond ETF may hold hundreds or thousands of bonds that trade by appointment not every second. The BIS study, The Anatomy of Bond ETF Arbitrage, found that for the largest aggregate bond, ETF, creation and redemption baskets represented on average only 3% of holdings. For the largest equity ETFs, the same BIS article reports basket alignment close to 100%. So in equities, the arbitrage loop looks like a clean mirror. In bonds, it looks like a representative sample. During March and April 2020, the same BIS study reports that tracking error in some bond ETFs rose above 200 basis points, compared with a historical sector average of 0.7 basis points. On March 23, 2020, the Federal Reserve announced the secondary market corporate credit facility, including purchases of corporate bond ETFs to support market liquidity. That historical intervention matters because ETF liquidity and underlying bond market liquidity cannot be fully separated under stress. The lesson is not that bond ETFs failed. The lesson is that the arbitrage machine had to operate through wider frictions. The same feature can even absorb shocks. A flexible basket can protect remaining holders while also weakening the clean arbitrage force. A bond ETF can trade continuously even when many bonds inside it do not. But a continuous ETF price is not the same thing as unlimited underlying liquidity. Now, the mental model is simple. An ETF price is not identical to NAV. It is NAV plus or minus the cost of making arbitrage work. For a liquid equity ETF, that cost can be tiny. For an illiquid bond ETF under stress, that cost can become visible. An ETF can transform liquidity, but it does not delete the liquidity risk of the assets inside it. So the next time you see a premium or discount, do not ask only, is the ETF broken? Ask a better question. What is the cost of turning the ETF share back into the basket? That is the hidden machine inside every ETF: creation, redemption, arbitrage, and the limits of liquidity. This is educational, not financial advice. The point is not to avoid ETFs. The point is to understand what their price is actually measuring.